So recently in the market, the technology sector in specific has been coming under a lot of fire lately due to the fears of high inflation, higher interest rates to combat that inflation, and the overall high valuations found mostly in the technology sector. Let me draw your attention to this chart because this paints a beautiful picture of what's going on. So I have a variety of ETFs side by side here, beginning at very broad market represented by VTI, and then we go further and further down the technology rabbit hole. We're filtering by the past 1 year, and we can see the overall market is up 12%. VGT is the first technology-focused ETF on the list, and this is the most broad, and it's done pretty well, up 14%. IGV is an expanded tech software ETF, and it's down 5% over the past 1 year. Next after that, we get even more specialized down the technology rabbit hole with the BlackRock Science and Technology Trust. As we can see on the chart, there's a high level of volatility and it's down 15% over the past 1 year. And finally, that leads us to one of the ultimate, most specialized technology ETFs, and this is the ARK Innovation ETF with the most volatility, and it's down 51% over the past 12 months. So the trend here is that the further down the rabbit hole you go into the technology sector, the worse the performance has been. Now, if I do zoom out to the past 5 years, usually it's the exact inverse. And here's a basic explanation for why this activity is happening. So stretched valuations coupled with rising interest rates have landed a 1-2 punch on technology stocks to start the year. After a long stretch of technology stock outperformance, which is important to remember, these two factors have sent the popular sector into a downwards spiral. So to put it simply, that's why technology over the past 12 months is struggling, because in 2020 and early 2021, they've had great overperformance and became really overvalued. And now there's fears of inflation and the Fed is going to be raising interest rates, and usually the relationship here is that when interest rates go up, valuations across the board come down. So technology, being more sensitive to these things, began to really struggle in early 2021, and it took until now, early 2022, for this pain to move over to the broad market indexes. So in a way, in my opinion, you can make the argument that these technology stocks are actually a bit ahead of the curve when it comes to this revaluation process that's going to affect all assets. As we saw in this view, the more you go down the tech and innovation rabbit hole, the more the correction has already happened. If you continue down the rabbit hole, Bitcoin and cryptocurrency is essentially as innovative and technology focused as you can get. And as we can see here, back when the inflation concerns began to happen, Bitcoin tumbled hard and fast. Although since then, being ahead of the curve, they've already recovered significantly, crashed again, and have began to recover again. And taking that same logic and working backwards, I think most of the pain and overall correction for these more innovative growth technology sectors is already behind us. We might have already established a bottom and soon might be moving upwards. So that's why in this video, I want to take a more dedicated look at two of the most hated ETFs on the market right now, the ARK Innovation ETF and the BlackRock Science and Technology Trust. They're very different investments, but they do share a lot of common DNA. And the fact that they're so hated and sold off in the market right now, in my view, could possibly create a good buying opportunity. And before getting into this, if you guys enjoy what I do here in my content, let me know, leave a like, subscribe, helps me out a lot with the algorithm, and I greatly appreciate it. But let's get started. Okay, so I actually want to begin with this article from Schwab, and this is a sector view on what to expect when interest rates rise. Up here, they talk about financials and how they tend to benefit with higher interest rates. But when it comes to technology, they say higher rates are not necessarily negative for technology. So it says, on the other hand, high valuations in the technology sector and growth stocks in general have been a growing concern. They've climbed to levels not seen since the internet bubble in the late 1990s. One rationale for the lofty valuations has been the extremely low interest rates. As their name implies, growth stocks' earnings are expected to grow relatively faster than other companies over the long term. These increasingly high future cash flows need to be discounted by prevailing interest rates, in a sense, comparing what future cash flows are worth today based on the alternative of investing in treasuries. The higher interest rates go, the lower the value of those future cash flows, all else being equal. So that paragraph basically summarizes what we already know is going on today. But it continues to say the problem with oversimplifying valuations in this way is that things don't remain equal. They change all the time. Higher inflation, which can push interest rates up, also likely increase revenues and potentially earnings, resulting in higher future cash flows, particularly if a resourceful company can increase productivity through automation, for example. Some stocks command higher valuations because companies have shown that they are cutting-edge innovators, so in investors' eyes, a change in interest rates may not be as relevant as the company's future potential. And this chart right here shows the correlation, or lack thereof, between information technology sector and the 10-year treasury yield. And the article goes on to say that capital spending tends to be a major driver of the technology sector performance. So during times of high fear, uncertainty, and doubt in the market, these facts are very important to keep in mind. Innovation and the resulting productivity increase is the major driver of growth in all economies, and the cost of capital or the interest rates, of course, affect this, but looking at the macro picture, it's really not that big of a deal. And we're about to take a look and see how BST and ARKK handle investing in growth and innovation, and if they really deserve to have sold off by this much. Okay, so when it comes to BST, this is their sector allocation. So 48% of their assets are in software and services. That's followed by media entertainment and tech hardware equipment. Geographically, they're also pretty diversified, mostly in the US, but also Japan, Netherlands, Korea, Sweden, and much more. And finally, in terms of their market capitalization, a lot of it is in pretty safe, stable, secure, large cap companies with a pretty good portion in small cap, giving you more exposure to that explosive growth and innovation. And in terms of how this ETF is operated, they select companies for their rapid, sustainable growth potential from the development, advancement, and use of science and or technology. And if we take a look at their holdings, we can see some pretty familiar and some even stable names like Samsung, Google, Amazon, AMD. Take a look at the software, we have Adobe as one of the major names. So to me, this is a lot of growth, innovation, and quality here. Now taking a look at the ARK Innovation ETF, they're even further down the rabbit hole on investing in innovation. In fact, unlike BST, the ARK team actually gives you a full rundown of how they screen and view different technologies. In fact, right here are the 14 transformative technologies that ARK Invest focuses on. So we have things like AI, digital consumer, digital wallets, Bitcoin, EVs, autonomous ride-hailing, and many others. And if you take a look at the article, they go through each platform one at a time and give you data and reasons for why these are going to grow significantly into the future. And for the market capitalization breakdown of even the ARKK ETF, over 10% of it is in mega cap companies, 61 is in large cap, and 23 in medium cap companies. Okay, so to conclude my argument here, yes, valuations across the board, especially in technology sector, have been very high over the past couple of years. And now triggered by the rising interest rates, these valuations are beginning to come down, and this correction is being spearheaded by the most innovative technology like the companies found in BTS and ARKK. But as pointed out in this article by Schwab, the economy is a bit more complicated than just the interest rates. And there's absolutely no denying that innovation and technology is a primary growth driver of any economy. The technology sector was just a bit more overextended in comparison to the other sectors, but it's my position and argument that the correction has already been priced in, as we can see here. It's pretty clear that Bitcoin moves in a similar direction as technology, and with Bitcoin, the price is already beginning to recover off of this negative news. And that leaves me thinking that right now is potentially a great buying opportunity for these kinds of investments. And full disclosure, if I come to my portfolio, I invest in both of these funds because I believe in their long-term growth outlook. And also, if you're an income-focused investor like myself, BST might be very appealing to you because it gives you exposure to these high innovative names, plus because of their covered call strategy, it generates a very high monthly income. And during times of high volatility, this comparative steady level of return is very nice. But that's just my stance on the market and my view on these two rather hated and sold off investments. Leave a comment down below on what you think. If you're still watching and enjoyed, give the video a like, subscribe, all that kind of YouTube stuff, and I'll see you guys in the next one.